For more reaction to Fed Chair Powell, let's bring in live from Jackson Hole, former Federal Reserve Vice Chair and past TIAA CEO Roger Ferguson. He's now a CNBC contributor. It's great to have you here. You were in the room, Roger. What's your reaction to what we heard from the Fed Chair? The time has come to adjust policy.
My reaction is, I think, is similar to what I've heard from others, which is that he was quite definitive. He was not at all hedged. A bit more definitive than I had imagined, frankly. At the same token, he was not in any sense, declaring victory completely. It wasn't a victory lap. So I liked the speech overall, and I think it reinforced messages that had been delivered that September is very much the time to look for the next move.
And what is that next move going to look like? 25,
I think
50?
At this stage, the odds... Yeah, I think at this stage the odds are much more towards 25. I know the market may be leaning a bit more towards 50, but this situation is not, getting out of hand. He observed that while unemployment has gone up, it is still at normal levels. So while he doesn't want to see it worsen, I don't think he feels the necessity to move dramatically. So I would suggest and expect a series of 25s as the most likely outcome at this stage.
He said that his confidence has grown, that inflation is on a sustainable path to 2%, talked about inflation expectations. I know it's the prevailing view that inflation is back on a sustainable path to 2%, but is there a risk in that view? We do still have pockets of the economy with higher than target inflation that's sticking around for longer than expected.
Sir, I do think there are some risks in that view. Let's be very clear. Core inflation and what's called supercore are both, well above anything that feels like 2%. And so another reason for them to be cautious is they don't want to lose control of the narrative. He identified inflation expectations as being an important part of this. If it looks as though, they are taking their eye off the inflation ball altogether, I think then there is some risk there. So that's, to me, yet another reason to move cautiously, even though he didn't use those words, but I would suggest that's the more likely outcome at this stage for a variety of reasons.
Where would you be looking, Roger, for a marginally lower rate to start to impact the economy first? Would you see it show up in discretionary consumer? Would you expect to see the housing pent-up demand get unlocked a bit? Where should we keep our eyes focused?
I think it's going to be in housing. I mean, it's the usual discussion around, inflation expectations. Obviously, because the labor market is still relatively strong, consumers are still doing reasonably well when it comes to wages. So I don't expect that to be the place where the turn is first seen. I think it's going to be much more, in those so-called inflation-sensitive sectors. Housing has been a problem for quite a while. Now, to be very clear, if you give me another minute or two, the housing story is much more than simply an interest rate story. It is also a story about the ability to start new homes, which has been very slow for a period of time. So I think all of this is going to take some time to play through. And I don't think, actually, as they reduce rates, that we're going to see the economy suddenly zoom or take off. I think what they're trying to do is keep it stable roughly where it is now, growing a little bit close to potential, unemployment not getting worse, nice balance between job market, supply and demand. So I think they like where they are, and they're not trying to engineer a reversal. They're trying to engineer, the stability of a soft landing.